Welcome back to Commerce Classes, friends. Good morning, good afternoon, and good evening, wherever and whenever you see this video. Hope you and your family are safe and healthy. So, coming to the lectures part, so all the parts of previous chapter, that is forms of business organization, and previous two parts of this chapter, business services, the links of which are given below. So, going towards just a quick recap of part one and part two. In part one, we have covered the various the basic introduction part of services and goods and the differences between them. Then we have covered the features and nature of services and the three types of basic services in which this chapter is mainly depend upon business services. As you can see that business services we are going to cover banking, insurance, transportation, warehousing and communication. And in part 2, we have covered the first, that is the banking services. In banking services, we have covered the various types of banks and various functions of commercial banks because mainly the functions of commercial banks are linked with the other types of banks also. Right? So, the agenda of our this part, that is insurance services. So, what is insurance services? For in general meaning, you can say that that we know that life is full of uncertainties, right? We do not know that anything can be happen anytime, right? So insurance is a types of service from which we are covering any type of life, property or anything. We are covering the risk of that part. So so insurance is that. So, in other words, I can say that insurance is a device or a term by which the loss likely to be caused by an uncertain event is spread over the number of years, right? Is covered, right? So, this is the basic description of insurance. Now, there are many type of insurance we normally see in our day to day life, right? We get calls, we get emails, right? We see in advertisements, right? Various advertisements. So now those insurance are being bifurcated or merged into few types. Like first one is general insurance and second one is life insurance. So general insurance means anything which is other than life insurance, simple meaning, right? So life insurance is a specific one, but general insurance covers everything. So general insurance is which is not a life insurance. So there are various other types of general insurance too. So the subcategories are, as you can see, fire insurance, marine insurance, and other insurance. In that other insurance, many types of other insurance are also covered, right? For example, burglary, cattle for cattle or crops in case of agriculture, sports, health, vehicle, and there are specific. These two are specific in case of India, right? So it depends upon country to country whether any specific insurance program or policy has been defined by the government. So it is a governmental policy, a general insurance policy in India, right? So covering one by one, what do you mean by fire insurance, right? So fire insurance is something like you are taking the cover of any property which you are thinking that it will be destroyed by fire in future, right? No doubt means you are taking the fire insurance. It doesn't mean that you are not going to face any fire incident in future. You are just covering the risk of that. Means anything if in utmost bad situation this fire occurred in your property, in your office or in your bungalow, in your residence, then the loss covered by that fire, that can be covered by the insurance company. So, and for that, we will be giving some amount of premium, annual premium, to the insurance company from which we are taking this cover. Like, right? Okay. The next is marine insurance. So, marine insurance is such that you are taking the cover, or you are making a contract whereby the insurer undertakes to indemnify the insured. Means the company goes into a contract with the policy holder to indemnify the loss, In how much the loss is extend to the value of the marine, which is defined at the time of making the contract for which property we are taking the insurance, right? So marine insurance thus provides the protection against the loss by the marine perils or perils of the sea. Simple. Now comes other insurance. So insurance, as you can see that there are many types of, this is just an illustrative purpose. So there are many types of insurance like burglary for any theft. So you are taking the insurance for any theft. You have something very precious at your home and you are taking the insurance for that. So if that is being theft, so you will get the compensation for that. That is burglary insurance. Cattle or crop insurance. So if you are agriculture, if you are a farmer, so you are taking the insurance for cattle's, your cattle's and crops. So if there is any death of any cattle or the crops is been devastated by the any of the natural calamities or any fire, something else, so you will be compensated by the insurance company, right? In similar manner you will be taking the insurance for sports, like if you are injured in sports, so that is so for that you will be getting the compensation. Health insurance, you are taking such that if you are admitted into a hospital and you are suffering from a disease, so the insurance company will bear all the expenses from that, with respect to terms and conditions, no doubt, right? Vehicle insurance, right? Obviously we all know that if we have a vehicle we have to take the vehicle insurance, and in case of any accident then the vehicle, we can repair it, or the third party damage, it can be covered by the insurance company, right? And in the similar manner, these two are the specific, just for illustrative purpose I have written here, amartya shiksha yojana or rajeshwari mahila kalyan bima yojana in Indian jurisdiction, right? So these are the specific governmental insurance which are provided to the citizens of India. So this was the general insurance part. Now comes life insurance. So since we all know that life is uncertain, right? All individuals try to assure themselves of a certain sum of money in the future to take care in case of unforeseen events or happenings, right? For their family, for the benefit of the family, right? So this insurance, the life insurance covers that. So the risk may be of an event which is certain, that is death. That, but I do not know whether that my death is coming tomorrow or day after tomorrow or 10 years later, right? But death is certain. But the event when it is going to happen is uncertain, right? For that, we take a life insurance policy which was introduced as a protection against the uncertainty of a life, right? But gradually, from the with the passage of the time, its scope has been widened, and there are various types of insurance policy available to suit the requirements of an individual, like you can see here in the bifurcation, like whole life policy, endowment life insurance policy, joint life policy, annuity policy, and children's endowment policy, right? So we will be covering this in depth now. So what is whole life policy? So in this kind of policy, the amount payable to the insured will not be paid before the death of the insured, right? Means it's a pure term life insurance, we can say in general market language, right? If in case of your death, the policy amount will be given to your family. So the whole life policy is taken for the security of your family. The premium, no doubt, the premium will be payable for a fixed period, that is 20 years or 30 years, whatever may be the policy required. So the premium is payable for that years or for the whole life of the assured, right? If the premium is payable for the fixed period, the policy will continue till the death of the assured. Like for example, my I'm going to insure my life till the age of 100, but I will not pay the premium till the age of 100. I will pay the premium till the age of 60. Then rest 40 years is free. Means no doubt if majority does not live till 100, right? So one day I must die. So after my death, the policy amount is given to my family. Okay, or the nominee, which we mentioned in our policy, right? So okay, so this was the whole life policy. Second is endowment life insurance policy. What is this? So the insurance, the means the insurance company, insurer, we can say, undertakes to pay a specific sum when the insured attains a particular age or on his death, whichever is earlier. Means in the whole life policy we have covered only death. In endowment life assurance policy means what? It has two conditions, that on the attainment of any particular age or death, whichever is earlier. Means what? The sum is payable to his or her legal heir or nominee named therein in case of death, right? But if the policy is for a specific period, means the earlier is the attainment of something age, some age, so you itself, the policy holder, will get the specified amount, right? For example, I am taking a policy for 20 years, right? For specific years, endowment policy for 20 years. So in case of my death before that 20 years, so the specified amount will be given to my nominees. But if I live after 20 years, the specified amount will be handed over to me, right? So that is endowment policy. Next, joint life policy. Uh, since the name itself suggests, it speaks that it's joint, means this policy is taken up by two or more persons. That is, the premium is paid jointly or by either of them. There is no there is no such situation that or terms that the policy amount or the premium amount should be given by joint, both the holders. No, either of the policy holder can pay the installment or the premium or lump sum in lump sum. So the assured sum or the policy amount is payable upon the death of any one person of the survivor to the survivors, right? If two persons are taking the policy, if one person dies, so the whole amount is given to the second person, right? So usually this policy is taken up by the husband and wife, right? Okay, so the next is annuity policy. Under this policy, the assured sum or the policy money is payable after the assured attains a certain age in monthly, quarterly, or half yearly. Like in endowment, we have seen after the attainment of any specific age, the policy amount given in a lump sum at once. If we cover for 20 lakhs or 20 crores, something like that, so the policy is given at once. But in annuity policy, what it does, it pays in installment. Whatever you have decided at the time of contract, at the time initial contract, right? If I want my money back in case of monthly installments or quarterly installments or annual installments, so the company will give you the money in that manner. So that is called annuity. So this is the policy, is this policy is more useful to those persons who prefer a regular income. Means from the very early age they start investing in any annuity policy, and upon retirement they get the regular income in form of annuities, right? From the life insurance, from the insurance companies. The final one is children's endowment policy. This policy is taken by a person for their children, right? To meet the expenses of their education or marriage or any specific criteria or any specific needs, right? So the agreement states that a certain sum will be paid by the company when the children attain a particular age. Children, not you. Children attain a particular age. The premium is paid by the person, means that is the parents, obviously. However, no premium will be paid if he dies before the maturity of the policy, right? So if the hope not, if the any of the children dies for which we have taken the insurance policy, so the policy amount will be paid. Okay. So these were the basic few illustrative life insurance types of life insurance policies, right? So if you will see the general insurance and life insurance, there exists a few basic fundamental principles and functions, right? So basically all are insurance, but as per the specific needs, these insurance are being bifurcated. So what are the basic fundamentals and principles? So if we go about the principles, so the base principles of insurance is that an individual or a business, because business also takes insurance, right? So an individual or a business chooses to spend a definite known amount in place of a possible huge amount of loss in future. right? So in simple terms, I can say that insurance is the substitution of a small periodic premium amount for a risk of large possible loss. Right? So see, this is the basic principle. But going into the further classifications of principles, I can say the first, that is principle of utmost good faith. It means what? That a contract of insurance is a contract of good faith, right? Which means a contract found on utmost good faith. Both the parties here, who are the parties? First is the normal persons, that is we call the policy holders, right, or the insured. Second is the company, that is insurer, RER, insurer, right? So both the parties, both the insurer and the insured, should display a good faith towards each other in regards to the contract. It is the duty of the insured, that is the policy holder, to voluntarily make full, accurate disclosure of all the facts which is material to the contract, and the insurer to make clear all the terms and conditions, right? So it is binding on the proposer to disclose all the material facts about the subject matter, right? And in case of insurance company, if that uncertain event occurs, it is the duty of that insurance company to compensate to the insured in a good faith, in a good manner, right? Without any hesitation. Okay, second principle. Second principle is that principle of insurable interest. So the insured must have an insurable interest in the subject matter of the insurance. Like, one fundamental fact of this principle is that it is not the house, ship, machinery, or potential liability of life that is insured, but it is the pecuniary interest of the policyholder in them which is insured. Means if I have a house, yes, but the house is not in my name. So what can I do? But I have an interest in that house. So I can take the premium or the fire insurance for that house. No doubt I am not the owner of that house, but yes, I can take the insurance for that. I have an interest in my house, right? So that is called insurable interest. Insurable interest in general terms means some pecuniary interest in the subject matter of the insurance contract. The insured or the policyholder must have an interest in the preservation of the things of life insured. Means if I am taking the policy for something, for property or from some machinery, so I should be of concern for that property and machinery. I want to keep a safe side of that property and machineries, right? So that is called pecuniary interest or insurable interest. Next point. Next principle is principle of indemnity. Right? All insurance contracts of fire and marine. Listen to my words very carefully. Fire and marine, but not life. Right? So all insurance contracts of fire or marine insurance are contracts of indemnity. According to it, the insurer means the company undertakes to put the insured in the event of loss in the same position that he is occupied immediately before the loss or before the happening of that event. In simple words, the insurer undertakes to compensate the policyholder for the loss caused to him due to damage or destruction of the property. Right? For example, what is the value of my life? It cannot be known, right? But what is the value of the property or the ship? It can be known, it can be valued. So in case of fire and marine insurance only, not in case of life insurance, the principle of indemnity applies, right? Means the compensation payable and the loss suffered are to be measured in terms of money. Life cannot be measured in terms of money, right? Okay. Next point. Next principle is principle of proximate cause. So according to this principle, an insurance policy is designed to provide compensation only for such losses as are caused by the perils which are stated in the policy. Means when the loss is the result of two or more causes, the proximate cause means the direct, the most dominant and the most effective cause of which the loss is the natural consequence, right? In case of loss arising out of any mishap, the most proximate cause of the mishap should be taken into consideration, right? For example, if I take, I have a property, and in that property an earthquake came, right? So it's an act of God. It's an act of God. But due to earthquake, right, there is a electrical shortage, and due to which fire occurs. So all my property is destroyed, right? So what is the main cause behind this? The main cause behind this is earthquake, due to which there is a shortage, right? And due to which the fire occurred. So, according to the terms and conditions of the policy, the earthquake is the main reason for the loss of property, right? So that is called the principle of proximate cause, which is the actual cause. Next is principle of subrogation. What does it mean? It refers to the right of the insurer to stand in place of the insured after settlement of a claim. After settlement, not before, right? So, as far as the right of insured in respect of the recovery of an alternative source is involved, means what? After the insured is compensated for the loss or damage to the property insured by him, the right of ownership of such property passes on to the insurer, right? So this is because the insured should not be allowed to make any profit. Like for principle of subrogation means what? Due to many fraud cases defined in this world, right? So this principle came like, if I have any property and in that property I have to compensate for something, means the company has to compensate me for something, for fire or for destruction or for burglary, right? Then that property is should be belong to the insurer or the company, passes on to the company, right? This is because the insured should not be allowed to make any profit. Means if I am claiming any insurance compensation from the company, I can sell again, so I am getting a profit for that, right? By selling the damaged property, or in the case of lost property which is not recovered. For that cause this principle stands true. Next is principle of contribution. As per this principle, it is the right of an insurer who has paid claim under an insurance to call upon other liable insurers to contribute for the loss of payment. Means what? If I have taken the premium from two or more companies, right, and if the destruction occurs of any property in case of fire or insurance, right, so I have to call upon all the insurance companies or all the insurers to compensate me, right? It implies that in case of double insurance, the insurers are to share the losses in proportion to the amount assured. If your property is worth 1 crore, right, and you have taken the insurance from three companies, so basis the insurance premium you are paying and the terms and the conditions, the three companies will share the risk and will compensate you with the insurance amount, with the cover amount, right? So that is the principle of contribution. Means every company should contribute to the risk, to the extent of risk they have taken. And the last principle is principle of mitigation of loss. This principle states that it is the duty of the insured to take reasonable steps to minimize the loss or damage the insured property. Means what? Suppose goods are kept in a storehouse, right, catches fire, then the owner of the goods should try to recover them. It is not that yes, I have taken the insurance policy, I myself should put upon the fire on the goods to take that claim. No, it is illegal. But yes, how much the owner can be or capable of saving the property, it should be done, right? The insured must behave with great prudence and not careless just because there is an insurance cover, right? So that is principle of mitigation of loss. So if you'll see, this principle is available in every type of insurance, right? One or more principle will be available in every type of insurance, no doubt, right? Now, upon these principles, we have few functions, right? What are the functions of these insurance, right? So first function is that function of providing certainty. So what does this function states? This function states that if you are taking any policy, right, no doubt the event is uncertain, but yes, with the help of insurance, insurance, we can, up to some extent, we can make that loss or compensate loss to a certain extent, right? So this is called providing certainty, means the insurance company is providing the certainty to the policy holders, right? So the next function is risk sharing. As I said, the principle of contribution. In similar manner, it is risk sharing. Means if one or more companies are covering the risk of any property, then in the similar manner, in the proportionate manner, they have to cover those risks. So they have to share the risk. So that is called a function of risk sharing. On the happening of the risk event, the loss is shared by all the persons exposed to it, right? Next function is protection. So the main function of insurance is to provide the protection from probable chances of loss, right? So insurance cannot stop the happening of the risk. As I said that if I take the life insurance, it doesn't mean I will not die in future. I must die, right? So insurance is just giving the protection. Insurance cannot stop that happening, so that is called the function of protection. Next, assist in capital formation. As we have seen in various life insurance policy that in case of death, the amount is paid to the legal heirs or the nominees of the policy holder. But if the policy holder is still alive, the policy amount, there exist few policies where the policy amount is given to the policy holder itself. So it is a part of financial planning. It assists in capital formation of the policy holder, right? So these are the basic functions and principles of insurance which you will find in every type of insurance, right? So now covering the basic few differences between life, fire and marine. Life is a specific category, but fire and marine are the part of general insurance, right? As you can see, what is the subject matter in life insurance? The subject is human life. In case of fire insurance, the subject is physical assets or property. In case of marine insurance, it's ship, cargo, or freight, right? What is the element in that? The element is to protect the life or investment of both. In case of life insurance, in case of fire insurance, it is the only the element of protection is involved, right? And in similarly, in case of marine, it is only the element of protection is involved, not investment. As we have seen, there are various life insurance where we get the money, so that is the element of investment. Insurable interest. So see, insurable interest must be present at the time of effecting the policy, mean at the beginning of the policy, but need not be necessary at the time when the claim falls due, right? And in case of fire insurance, must be present both at the time of initiation of the policy as well as the claim falls due, right? But in case of marine, opposite must be present at the time of when the claim fall due or at the time of loss, or right, either of one. Now duration means when we what is the maturity of that insurance which we take. So usually life insurance is taken is more than a year, which may range from 5 to 30 years or maybe more than that. Okay, there are various schemes, but for fire insurance, the policy is only for a single year, means we have to renew our policy every year. And in case of marine insurance, policy is one or period of a voyage or mixed, means we do not know how much the time will ship it take from one destination to another. So policy is for one period or a voyage or a mix of both, right? Next is indemnity. As I said that life insurance does not cover the principle of indemnity, but yes, fire insurance and marine insurance can cover the principle or holds good the principle of indemnity, which means what? We can value the loss of property or marine, right? But we cannot value the life. Loss measurement. See, as I said, life is not measurable, but yes, the property can be measurable in case of fire insurance, and the marine or the ship or the cargo can be measurable in case of marine insurance. Surrender or paid up value means the policy value. Life insurance policy has a surrender or a paid up value, means if in case of death the policy value is fixed, it will be given to my legal heirs or nominees or my family. But there are, in case of investment life insurance policy, it will on attaining of specified age, it will be surrendered to me. That is called surrender value, right? In case of fire insurance, it doesn't have any surrender value. Means what? You are taking the fire insurance, it doesn't mean that you will get some amount if in case fire doesn't occur, right? So that is the case. And similar in the case of marine insurance, unless and until you face any loss, in case of fire insurance and marine insurance, you will not get any value or paid up value. Policy amount. One can insure for any amount in life insurance policy. Means one can take any amount, like for 1 crore policy or 2 crore policy or 10 crore or 100 crores, any amount, 1 million, 10 million, anything, right? But in case of fire insurance and marine insurance, the amount of the policy cannot be more than the value of the subject matter. As I said in the principle of indemnity, that the value can be measured, and based upon that value, the policy amount is decided. Right? So, in case of marine and fire insurance, both the policy amount should be valued or cannot be more than the subject matter value. And the last distinction is contingency of risk, right? So there is an element of certainty, means the event that will occur, but we are not sure when it will occur. But yes, that will occur. Upon death, my family or nominee or the legal heirs will get something, right? But in case of fire and marine insurance, the event is uncertain. Means it is not so that we are taking the policy that it may cause fire insurance or sorry, fire or any marine type of losses. These are uncertain events, like fire may occur or may not occur, right? So these are the basic few distinctions. Just think upon the insurance type, and you will get all the concepts, right? But even though in case of any query, you can comment upon. And if you like this video, please like, share and subscribe. Thank you and stay